the topic is very, very, very timely. So everybody heard already that contracts for differences have been used in the past, but all of a sudden we have this energy crisis. As a result, we have an electricity market reform. And one of the solutions that are currently considered are these contract for differences. So we thought excellent moment to invite a few academics, because in the last few weeks and months, I was surprised that everybody was proposing new type of designs for contract for differences, but at the same time, there is already quite some experience. And then I was happy to bump into Professor Lena Kitzing, and Lena is with us here, and she has already been working on this for quite a while, and she has a lot of empirical work on this topic. So she really knows how these contract for differences have been implemented in different countries. Just to share two papers she sent to me and that you could also read afterwards. She had one on policy choices and outcome for offshore wind auctions globally in 2022, so very, very recent, and another one from 2020, also quite interesting, on offshore wind competitiveness in mature markets without subsidy, because that's also some of these novelties we see in the renewable space. Then we always like to have at least two discussants, and this time we have invited Dr. Anna Held, and she's from Fraunhofer. So Lena is a professor, associate professor at DTU in Denmark. Anna is with Fraunhofer, also already working on this topic for a very, very long time. Just to quote two papers of hers from 2016, she was really looking at the concept to assess the costs and benefit of renewable energy use and the distributional effects among actors. And I guess that's also a topic that will come up here, because the way you design probably has some impact on, the cost benefit of consumers versus developers as well. 2017, she was also already anticipating that renewables are becoming more mature. And then what does that imply for policy? Then we have Pablo with us, another professor. He's from Comillas, and he has also been working already with the whole Comillas team for a very long time on this topic. Just to quote also two papers from him. One, 2014, I found particularly interesting, where he looked at electricity auctions in South America, asking the questions, do we see a convergence of system adequacy? So this kind of capacity mechanisms and renewable support. And 2017, I think, is also quite interesting, because some of the CfD design proposals we have seen lately talk about this kind of reference power plant that you would use as part of the scheme. And they already discussed that in a paper revisiting RES in adulthood towards market compatible schemes. So I think I've justified enough why we have these three experts here. Of course, as a host, I'm not alone. You know that. Lucila and I host this together. And Lucila also promised me to help, because especially today, with such a big number of registrations, we expect you to be very active. We expect you to use the chat box, the Q&A box, and we will try to filter together and take the most prominent questions from there. Okay, so now the next step is that we have about 20 minutes for presentation by Lena. Then we will have the two discussants asking a few questions to Lena and also to complement what she just presented. And then it's up to you to ask questions. So Lena, please, the screen is yours.
Thank you very much, Leonardo. What a pleasure to be here today. Let me set my presentation up. I think you need another jingle for this small break.
If necessary, I can sing, but I'm not the best singer.
All right.
Go ahead.
Can you see my screen all right?
Yeah, it's perfect.
Okay, very good. Well, yeah, so thank you for the great introduction, Leonardo. And I think it's a really timely topic to talk about contracts for differences, which we have indeed worked on for 10 years around now. What I'm going to do is I try to keep within the 20 minutes and just give a few basics and some empirical work on the implementations, and then some reflections on these implementations. And then I'm looking forward to the discussion afterwards. So the first question, what are contracts for differences? And the answer is they are financial hedge contracts. So you can also think of them as a financial derivative, which means that two counterparties are making a contract on a certain underlying without selling or buying the underlying, right? So in the financial terms, contracts for differences are fixed for floating swaps. One counterparty is exposed to a variable price, which the other counterparty is fixing for them. And then they agree on a price for that. And this is not special for electricity. It's actually quite a big business. There is a lot of fixed for floating swaps around. What is a little bit special in this case here for CfDs, especially when we use them for renewable investments, is that there is no market where you can go to buy these fixed for floating swaps, because these CfDs are very long term, 15 years, sometimes 20 years. So they are provided by a government entity, typically. So let's have a look at where we have been seeing them used. So this is only a statistic for competitive procurements in Europe. So it's not the full renewable energy procurement, but you can see a couple of points on this page here. So it shows the years that we've seen two-sided CfD implementations and the share of the number of the procurements overall that we've seen. And a couple of points can be made here. They are a relatively recent phenomenon. This statistics does not include all CfDs, but they have increased a lot in traction over the past years. You can say that around half of all the procurements use CfDs in Europe, of all the competitive procurements and all the auctions that are being done. Around half of them use CfDs for renewables at the moment. And that's rather similar across all of the renewable technologies. And then another interesting point is that although we are seeing around half of the procurements being used, half of the procurements using CfDs, there are only 9 countries in the European Union that actually have tried to do a two-sided CfD auction, which are listed here on the side. Okay, so let's have a look. Why are we doing these CfD procurements? In the very beginning, it was purely based on subsidy considerations or support considerations. Renewable energies were quite expensive. They needed to be procured at a rather high cost, and that price, a certain price, needed to be guaranteed so that they would be invested in. But then over time, this happened. You can see this is from one of the papers that Leonardo mentioned earlier, where we have plotted all the strike prices, the procured prices for offshore wind in these European countries. And we can see that the subsidy part of the procurement is becoming less and less important. And we've already even seen some negative support procurements during these auctions. That's of course only possible in a two-sided CfD. So does that mean that we don't need CfDs anymore? I've maybe already hinted towards that on the first slide. It does not. The role of the CfD is changing, and we are now looking a bit more into the role of CfDs as a market creation instrument. And that is because we cannot go into the market, into the forwards futures market at the moment and actually buy these fixed price contracts for 15 years at a time. There are PPAs, they are a little bit limited. We can also take them up in the discussion later on. What we are seeing is first, the role of the CfDs in a market creation environment is that the current structural design of the market fails to provide investment incentives or investment security for renewables, even if they are otherwise profitable. And another point that has just arisen last year is the notion of benefit sharing under two-sided CfDs. there is certain revenues with very high prices where the government gets a share of the return of these very high prices. So the benefit sharing is also becoming more important in these CfDs. So these are some of the reasons for procurement. Let me take you a little bit more into depth of this structural design of the markets and how it does not provide investment incentives at the moment. And this answers the question why CfDs are so relevant for renewable assets. If you look on the left side, you can see the distribution of different cost types over the lifetime of energy assets, comparing fossil fuel and renewables assets. And a lot of people have realized that during the energy crisis as well. If gas prices are high, the fossil fuel generations costs are very high. So that's the gray part here. Over the lifetime, around 85% of all costs for fossil fuels come from their operational expenditures. And this is not the case for renewables. For renewables, it's the initial investment that is the major chunk of the cost. And if we are expending such a large amount of investment, we also need to finance that. So if we are separating out the financing cost from the capex cost, we can actually see that this is also a very high amount of the overall expenditure. So this is taking up the loan and then paying interest rates, for example, or paying back your investors. If you look on the right side of the picture, it's exactly those financing costs that are impacting the levelized cost of renewables very, very much, and much more so than for fossil fuels. So that is also why we are talking about revenue stabilization, much more about how to bring down financing costs, because that is so much more relevant for renewable energy than for fossil fuel or thermal generation. So in this picture, you can see that at around 8% cost of capital, the financing costs make almost half of your full lifetime cost already. And in increasing interest rates environments, the LCU actually can increase quite quickly for renewable energy. And that's something that we should keep in mind. So a lot of the support scheme design that we focused on, especially also in our research the past years, was how to de-risk renewable energy so that it can keep the prices down through financial engineering, for example, taking out risk. And I just wanted to show you how that exactly works in practice. So if we are comparing gas-fired assets and wind assets here over their lifetime, because there is such a large investment chunk, the wind assets have to pay a lot of debt service, whereas the gas-fired asset does not. On the other hand, of course, the OPEX is much smaller and fixed, and the gas-fired asset is larger and variable. What we've seen typically in the market is that for gas-fired assets, the OPEX and the revenues from the market, they are correlated. So that here you can see in times of low electricity prices where there is a dip, this is not a cash flow problem for gas-fired assets because their costs go down. But for wind assets, this becomes can become a cash flow problem, and they can go into financial distress. And risk of financial distress translates into higher financing costs, higher cost of capital. And this is one of the problems with the structure of the markets as they are created right now. They are more suited for the cost and revenue structure of these fossil fuel assets than they are for renewable assets. And this, in principle, has nothing to do with the long-term average cost of each technology. So the wind asset can have lower long-term average costs and still run into these financial distress periods. Of course, you can also do something about that financial engineering. So this is a very simplified illustration, but I think it should show you what can be done. If you do liquidity management, if you do any other products, these are going to be costly, and you have to do something. So that's for why we have CfDs. Let me move on to what they actually are. And I think that's maybe where my presentation gets most classroom. So please stay with me here. I will show you a couple of examples on how CfDs work so that you can understand how they function. So contracts for difference means that you're entering into a contract, so between the renewable energy producer and the state entity, and you enter into a strike price that is set fixed. So 100 in this example, you will always get your strike price. It's a purely financial contract, which means that as a producer, you will still go onto the spot market and sell your power there. There will be no physical interchange of actual power. It's just a price. So what happens is if you will then look into the development of the reference price, just for the pure financial settlement of the contract, you will look into how the reference price is developing, and whenever there is a gap between the strike price and the reference price, there will be a CfD payout up to the strike price. So far, so good. That is simple. There are some cases that make it a little bit more complicated. For example, what happens if the market price goes above the strike price? And here, in a two-sided CfD, we say what happens is that there will be a clawback. So you will still only get the strike price of 100, and the state will take these 45 in addition. In sliding premium implementations, which are not CfDs, sometimes they are referred to as one-sided CfDs as well, but these sliding premium implementations, the generator will keep the market upside. This is the case in Germany and the Netherlands, for example. So there's two different implementations of how the clawback can work. So let's assume that there is another period where there is a very low market price. And in principle, of course, there should be another CfD payout. It can happen in some implementations that there's a netting, so that you're not actually paying something back, but you're netting up to the next period. But this is a rather rare implementation. Usually it looks like that. There is a clawback, and then in next period, you will get another payout. So the next interesting question is what happens at negative prices? We've seen the CfD implementations in the past, where the CfD payout then was 100, which is the maximum that was paid out for the strike price. And then, of course, you can say this gives some distortions in the operational decisions of the CfD holder, because in theory, we have negative prices, which means that we have too much generation on the market, and the generator should, if they can, stop production. If they are still getting the 100 payout, they're making a profit, and they would not stop production, which would mean a problem. The most implementations of CfDs at the moment do not pay out the CfD at negative market prices, which means that there is a stop of support, and there is an incentive to also cease production during these hours. So stopping support at zero prices, that works well with zero margin technologies or marginal cost technologies on the day-ahead market. So that's one of the design features of CfDs. So I hope that I captured most of the situations. If there's anything, we can also have that in the discussion later on. What I would like to move on to now is the different design elements in CfD implementations, and that's quite a busy slide, but I will talk you through it. So I'm just showing you a couple of different design elements that we have seen in CfD implementations. I don't say that they're good or bad, or they have to be like this. They could be, there's a lot of creativity around, as you will see. But I grouped them into three different groups. So contract design, reference price design, and then clawback design. Let's have a look into a few. So, and then based on these different design options that you have, what policymakers do, they will use, like a Lego block, will put together and click together these different design options that they have. For example, how long should the CfD be paid out for? So it could be 15 years, could be 20 years. It can also be based on a lifetime volume. Other elements are, for example, how do you determine the strike price? Is that administratively set, or is it an auction? Is it negotiated? Can you exit the contract or not? So that's on the contract side. Reference price design, that's an important part. So what is the yellow bar that you're comparing with in the price? Because that will determine the payout. And here we've seen several different implementations. The easiest maybe price indexation. Is the reference price or is the strike price increasing in the determination of the payout? The averaging period is also important. You can have, as I said showed in my first example, you're just looking every hour. You can see what is the price, and then you're calculating the payout. There's also several implementations where there is a monthly determined average price that becomes the reference price against which the strike price is determined. This is actually quite popular. I will take that up in the coming example as well. Then how do you average? If you're doing an averaging, how do you average? Is it on a base load level? Is it on a peak load level? Or is it maybe technology specific volume weighted average? Do you pay out at negative prices? I've covered that. And then also, how do you design the clawback? Is it two-way with two-way payments, or netted, as I showed before? And there's also a potential price distortion at very low prices if you have to pay back in a certain period to the state or to the counterparty. That would, if you pay back too much, then you would cease production too early, and that also needs to be taken into account. Can be done. It's all parts of these design implementations, and then basically what you do is you choose from these design implementations the ones that fit to your scheme, and this is very context specific and also evolving. Just one example: when the first Danish CfDs were done quite early for offshore wind, we didn't even have negative prices on the market, right? So there was no payout regulation at negative prices there. And of course, they need to adapt to changing market conditions. But one point that I would like to make is that there is no conventional CfD design that you can point towards. They are all different, all highly context specific, and all of these evolved at the same time. There is nothing that started out with and then moved on to some other design. Okay, so regarding some design criteria that we should look out for regarding the CfDs is we want to create optimal utilization in the operation of the plant. So they should always produce when the price is above short-term variable cost, and should never produce when the price is below, the market price is below these costs. And it should be on day-ahead market, intraday market, and also balancing market. And then also the maintenance should be scheduled so that they are optimal for value and not optimal for cost. Regarding the incentives for investment, we've also looked into that quite a lot. You would like to have the plant to be designed in terms of siting, in terms of sizing, in terms of technology choice, so that its generation is system friendly, that they produce what you need. And that could be, for example, longer wind turbine rotors or west-facing solar panels, where the new technologies that come onto the market don't produce exactly the same as all the other technologies already produce, thereby helping the system overall. So the different design choices, they help on these incentives. Just one example, if you're going between hourly settlement or an annual flat average. So generators in the hourly settlement, they always achieve the strike price. There is no price risk whatsoever in that scheme. That means that it incentivizes to maximize production and also incentivizes to cost minimize operations and maintenance. However, as soon as you're starting to do some averaging, this incentive is changed. If you are doing a volume-specific, technology-specific volume-weighted average, you will have some price risk. It's a low. You have an incentive to beat your siblings. If you're producing higher value power than all the other offshore wind producers, if you are an offshore wind producer, you can beat your siblings and get a little bit higher return there. So that's already helping. If you're doing an annual flat average or a monthly flat average for that sake, you will have even higher price risk because your own production is not exactly settled against the your own achieved price is not exactly settled against the reference price, but or is deviating from the reference price. But it will also give you an incentive to beat the market, to be better than the market in that sense. So there's already a larger system integration benefit by doing that. It also helps if you're having longer averages, it helps also optimizing maintenance across seasons and other things. So there's also benefits there. It increases liquidity risks as well because price swings can help. So there's always a trade-off in these design choices. Okay, I will come to an end soon. Let me see. Some lessons learned and the discussions that we can have regarding these CfDs is there has been quite a lot of discussions around that CfDs in general provide these produce and forget incentives and mute electricity prices. I would say this is a myth because it all depends on the design choices. And I hope I could make the point with the averaging just before. It is possible to design incentive compatible CfDs that don't distort bidding behavior on the day-ahead market by choosing some of the choices, longer averaging, no payout at negative prices, and limiting the clawback at low prices. However, there are unresolved issues that we have not seen yet in the implementations, especially regarding intraday and balancing market. There are distortive effects and spillovers from the day-ahead market that lead to exaggerated downregulation, and that's not something that we want from the renewables. And then also, what I think we're going to see more and more of in the future is hybrid plants, self-consumption, especially for hydrogen, for example, where we can risk to have sub-optimization adverse system behavior where the generators try to avoid clawback by cross-energy carrier optimization. Let me say that. So this is something that we've still not seen resolved. There are several solutions discussed on the market, which I'm sure will come up later on in discussion as well. There's only one thing that I would like to just mention on this, because a lot of emphasis has been done on non-production based CfDs. And one of the lessons that we've learned from support scheme design, and the reason why we have megawatt-hour based support scheme design at the moment implemented in most parts of the world, is that it is quite important to align the incentive with what you are actually asking for. We've seen investment grants and other support schemes fail in the way that they always opened up some you can say, room for market strategy, which is maybe not exactly what was necessary or was needed, because the governments, the states want valuable electrons. They should ask for valuable electrons. I think that's what I mean with incentive alignment. There are still more open questions that I think we can discuss, and I don't have the answer to, I have to say. Is the state the best counterparty for CfDs? I don't think so in all cases. Are there other players? Are there better players? I haven't seen them either, so we can talk about that. And then also, I think in relation to the ongoing consultation from the European Commission, when does CfDs actually, when do they constitute state aid, or when is it a support? And that's something to do with the level of the CfD. Do we actually expect any net payout from the state to the generator or not? And who is going to determine that? I think that's still an open question to me. Finally, I think CfDs are much more diverse than what it may seem like. And the design specifications are highly context specific. There are some compelling arguments for a more permanent role of CfDs just because of the structural difference that I started out with in the talk regarding the financials of renewables. But there are unresolved issues that remain. And we're discussing some of these solutions. I think jumping to full market scale, if that's what is necessary, raises many more questions. I think that we also should look into the scope of the technology, which plans should look into that, the volumes and the timing of the procurements. There will be competition effects and also on parallel options. I think we will have to see that it's the role of the PPAs, private contracts, and how they will be integrated, with CfDs, especially if they become mandated. And also coordination across countries is still an open question to me. That was my presentation. So I'm looking forward to the questions and answers.
Great, excellent presentation, Lena. And maybe I suggest to you a new title for your next paper: CfD, beat siblings or beat the market? That was the I never heard that expression, but it sounds appealing. Okay, so we have two discussants. And meanwhile, I think we already get a lot of questions in the question box, so I think we will also leave some space for that. But of course, we kick off the discussion. On my screen, I see Anna first, and then we can go to Pablo. Anna, please.
Yeah, thanks a lot, Lena, for this excellent presentation. Very useful explanations, and I think I can quite agree with you on the presentation. So you stated that the CfD design is really important, that it's not a question whether to use CfD, but it's really the question how to use it and in which context. And maybe in this regard, I would like to make a few comments and maybe also kind of compare the CfD towards other remuneration forms in the renewable energy sector. So I'll start a bit from the renewable energy sectors and maybe towards the end of the comments also give a few hints towards other technologies or where it could also be a good field to apply. So in the beginning, you've already stated that the contract for difference is often compared to premium payments, or that it's kind of a premium payment for renewables, that part of the remuneration is taken from the market, and the other part is kind of a public support. So the CfD is a special form where it kind of offers also a clawback if the renewables operator makes a lot of profit. So in this context, what's really important from my point of view is in which context the CfD is applied. So it makes a difference whether it's kind of stated administratively or whether you kind of determine the level of the CfD in an auction. Because the bidding procedure really determines the output also of the CfD and also the level of the premium payment. One example is that, for instance, if you compare a sliding premium, so a premium which adapts to the electricity market prices with a CfD with a clawback or with a payback. That if you participate in an auction, that usually if you anticipate like high market values for your technology, that you kind of factor in this additional profits, and that you kind of adapt your bid for the CfD. So in the analysis we've been doing, we've been seeing that the difference maybe between a sliding premium without clawback and a CfD can be quite similar, given that the bidders that they really consider this for their context. This is only one example why I wanted to kind of explain or show that it really depends on the context and also on the combination with other parts of the instrument design. Maybe another issue, what you stated, is that renewables are rather capital intensive. So in this context, I think contract for differences are really a very good a measure to de-risk and to try to reduce capital costs. But what happens if this changes? If you have a higher share of variable costs in the productions, for instance, you showed the example of gas. Is then the CfD still the right instrument, or does it imply other problems, like also, for instance, at the side of the government, because the government needs to provide for the support, and then if you have more security for the renewables producers or for the energy technologies, then you have the uncertainty at the budget side, and in the end this will be passed to the consumer, so it will end up to costs for the consumers. So I think what we need to separate really is the objective of the CfD. Is it rather de-risking, or is it kind of filling up a competitiveness gap? So I think we've seen quite an evolution during the last years, that previously, like 10 years ago or so, maybe the focus was more on this support gap, and now it's becoming increasingly the de-risking issue. And then the second question is, do you want this de-risking issue to be publicly managed, or do you want it to be private? So this is a bit the question also, or where the PPAs come in, so the power purchase agreements, where the players on the market, where they try to hedge their risks with private partners, and where you can try to incentivize also this private risk hedging. So this also has to be considered. So maybe one last aspect is that in the case of renewables, you have a very good reference price. You have a liquid power market price in all the countries, so it's kind of a good measure. But what happens if you kind of try to use a contract for difference, for instance, for the hydrogen market? So as a new technology, which also may need support, and there you may have the problem that you don't have this liquid reference price. So the question is whether such an instrument like a CfD, whether it really achieves the primary objective of de-risking, or whether it adds too much uncertainty on this point. So I fully agree with you, Lena, that it's a question of how to implement it and how to really detail, or how to structure the detailed design of the instrument, depending on the circumstances, on the technology, and on many other factors. This is also why I would like to kind of recommend to have a look at these issues, and not to come up with very quick suggestions, because I think there are a lot of interactions, and you have a lot of interrelations between the different parts of the instrument. You have the market design, and I think it's really important to have a look at this, analyze this thoroughly before coming up with whatever suggestions, and later on it turns out that there are effects that you haven't considered or something. So yes, I think this is a bit my take on my first comment on your presentation, and I'm really looking forward to what Pablo will be saying. Thank you.
Yeah, and I suggest, Lena, if it's okay for you, that we ask Pablo. Then if you want to do a short reaction, it's okay. But then I think we go directly to the questions, because actually you are three really good experts that together I think can complement each other in answering these questions, right? Because we have 19. So the tough challenge for Lucilla is to pick one and hopefully more than one that we can address. But Pablo, please, a few comments.
Okay, well, first of all, thank you very much for inviting me to this very interesting session. And thank you very much, Lina, for that very nice presentation, very clear. I also have some comments. Well, first of all, I have to say that I fully agree with the framework that you said, that the crisis has shown that we clearly need in Europe long-term contracts, long-term hedges, let's say, and this can be a forward, an option, a contract for difference, a PPA. I think that there is a lot of confusion with the terminology. Sometimes it is the same, what we are saying when we refer to different of these names, but it was great to clarify what is contract for difference, because it is an umbrella that covers many other type of contracts. It is clear that these contracts are good for generation. It is something that we have known for decades, that to the risk is good and facilitates the investment. Now, what is something that we also knew, but now we see it clearer than ever, it is that it was also necessary for the demand, that the demand otherwise can face very difficult situations. As you mentioned also, I also agree that's a fact, that long-term markets are not working, and indeed, I saw quickly that some of the questions are related to that. We don't have markets for contracts that are beyond 3 years. So there are all these Acer reports that show that we have certain liquidity for 1 year, for 2 a little less, 3 there's almost nothing, and beyond inexistent. And that is what we are talking about. So we don't have that market. It is what is known as a market failure and incomplete markets. And this is where the regulator, the government, has to do something, has to take action. And indeed, related to what Lina was mentioning about the problems for a technology of facing low prices and the problem also of trying to hedge the high prices for the demand, this is precisely what has been done in Latin America for decades. They face these problems. The drivers are not the same, but in the end, there were periods with very low prices that were problematic for the generating technologies. There were periods with very high prices in which the demand could suffer if they were not hedged. So in the end, they came to this conclusion that we need to enter into some type of long-term contract in order to solve both problems at the same time. What type of contract depends on the system. In some of them, it is a forward with a base load profile. In some others, it is a forward with the load profile. Some others, it is a call option with a low strike price that is in the range of the variable costs. In some others, it is a very high strike price. This is the so-called reliability option that has been also discussed in the context of the current situation in Europe. But the conclusion was we need this to help both sides of the markets. We need to complete the markets. And this is the discussion we have here. So if we have to take action, and if the regulators want to take action, from my point of view, well, there are many decisions to be taken, but there are like 2 blocks of decisions. One that are more policy, let's say, policy decisions that are related to who would be the counterparts of this contract, whether it is voluntary or not. And the second has to do with the design of the contract. And here, as we have seen, there are many parameters. Indeed, well, a contract for differences, it is just 3 parameters. It is as you have mentioned, it is the strike price, it is the reference price, and it is a quantity. But how you define each of these 3 parameters give way to dozens, to many different contracts with different properties. So my questions would be one for each of these blocks. The first one, it is which should be these counterparts? Should it be all the demand, only part of it? Should it be, because here we are focusing a lot on renewables, but the discussion in Europe goes beyond renewables. Should we include all the technologies, only new investments, or who should be these 2 counterparts? And the second, it is in line with what Anne mentioned before, which is, it is true, and as you said before, this contract is, in the past were designed to completely de-risk investments. But now we are facing another problem. We are trying to hedge both sides of the market. So how should we reallocate the risk between these 2 parts? Or is it still beneficial to the risk completely the risk of the investor? So that would be one for each of the blocks. Those would be my questions. Thanks.
Thank you, Pablo. And I think that already matches several of the questions in the Q&A box. So maybe we can start to see if you have the same answer or not. Anna already hinted a bit, no? I got the impression that she was not sure if it should apply way beyond renewables to these more immature technologies, because she was not sure if you could establish a strike price as good you know, for these more immature than mature. That was part of the answer. But Lena, do you want to go first? So counterparty, voluntary, mandatory, renewable, what is the scope of the CFD contracting? And then I'll ask Anna to see if...
Yeah.
Not the easy, just to start with the easy questions, right?
Yeah, yeah, I completely agree with you, Pablo, that so what we're dealing with majorly now is not supporting unprofitable renewable energy anymore, right? There are still applications that we should not forget, you know, and we should keep going. But what we are really facing now is how do we complete the incomplete market? There is an incomplete market that cannot trigger the investments that we need, right? And I think that's what to do about that. I don't think that CfDs are the only solution, right? I think as much as the market can manage to provide, you know, the de-risking and the investment incentives, we should try to let the market do it. And I agree, there is some demand from the demand side as well. They want to go into long-term contracts, and so PPAs, I think, will play a much larger role. And as long as they can do that, I think they should. I think that they will not deliver the volumes that we need for the energy transition. So we will need to have something that supplements PPAs. And how do you do that? By creating better, more longer-term forward markets, you know, by creating potential trading new products that can be traded on a pool with government backing. Fine, it can be done. It will resemble CfDs, maybe. We need standardized products for that as well. And if that's not working, then or as much as not working, you know, we can also go and revert back to the, you know, one-on-one CfD contracts for a state with a certain generator. I think we should look into all of these options and see what will be best. I don't think that you know, continuing with the CfDs that as we do now by auctioning out, you know, certain volumes at a time, I don't think that's the solution for the whole problem. I think that we should keep that in mind, and I hope that answers most of the questions regarding public and private as well that Anna had. And yeah, in general, I think one of the things that I wanted to mention is that as well as we are still developing the market, right, for renewables. I think we should not forget that most of the renewable capacity that for Europe is not built yet, right? It's still to come. And we also need to remember that this is something that we need to make happen. And this means also that the sector needs to be attractive enough that there will be a development coming, right? So this is a balance on both sides as well. And that's also maybe one of the hints that might come in the questions regarding, you know, retroactive changes for existing plants. Yeah, I think in some way this is the smaller problem that we have, right? So I think forward-looking, we will look into many more volumes than we are dealing with today.
Thank you, Lena. I'm looking at Pablo or Anna. Do you want to complement, or do you have a different view?
No, I think I agree with most of the points. Also, I have a preference for private hedging if it's possible, and I think markets really, in principle, work well. And what's really important, I think, is that if we implement some kind of contract for difference, that the principal market functioning still works, and that the dispatching and the different incentives, that they stay in place and that they work, because I believe they have been working. And if prices are high, this is because there's scarcity. This is just, I think, for my side, a very, very important issue to consider. For the rest, I think I can agree to most of it.
Okay. Thank you. And Pablo is also nodding. So Lucila, let's go to the question box.
Yes, still, I think, Lena, thank you so much for the presentation. I think it was incredible, good, and as well accessible. And I think the consequence of giving accessible presentation is that we have many questions. No, people indeed got your message and got the point. And I tried to apply Vox Populi as well, see what questions like people like it most. And I think I will address like a couple of them and see if you can handle in this last 10 minutes. Perhaps let's start from the first one. I think it was interesting because the question of Vitek Vasily, it was about contract design, especially to what extent the CfDs would incorporate some clause that would correct inflation, and not only inflation as well, thinking about the cost of capital. Now it's increasing with the Eurobond. Whether in the contract you have this increase of strike prices in this regard. I think it's an interesting question. Let's see. Here we have like the question of Liz, of Pablo as well. Both Pablo and Lizzie as questions about how CfDs would distort markets. Discussion of Pablo asked specifically on intraday markets, no, and Liz asked about distortions in forward markets. I think it was also another interesting questions. And we have questions as well about the CfDs designs between member states, whether the difference of this could affect, for instance, the internal market. I think these are three interesting questions, and I'm ready to have your full plate at the moment.
Okay, I will start with the easy one. I think that's the number one, right? So that's regarding indexation and interest rate risk. So there are some implementations that index the strike price, yeah, so that it follows. I think if you look into very low marginal cost renewable technologies, they're only exposed to increased to inflation through the operational expenditure. So that's a really small part, right? And usually the interest rates in the loan, they can be fixed, right? And if companies choose not to fix them, that's the risk that they're taking, right? Typically, they won't do that. So that is something that I don't think should concern the CfD design, because that's part of the market risk or choices that can be taken. Typically, there is one loan over the whole period or for the CfD period, and this is then the reference, that we are trying to match. Having said that, of course, there is a period of risk between being awarded or agreeing on the strike price and then actually constructing the plant and then closing the financial close. Yeah, and there might be some risk, and we've seen that now with increasing interest rates, increasing costs over from the supply chains, that some developers come into some trouble. And we've also seen some suggestions by policymakers. I've now seen some first suggestions from the US, where there is some indexation, that could adjust for these prices. I'm not so sure that this is necessary, for policymakers to worry about, because that's also something. There are products out in the market where you can hedge yourself from that. Of course, that there is a cost to it. That can be priced into the bid as well, right? So. I would not see that as one of the biggest problems, right? So then the question regarding the differences in CfD designs between the member states, and I think that's something that we will need to look into. At the moment, I think if you design the CfD so that it is distorting the electricity price the least, then it does not distort the behavior on the market, which is the one that's cross-border, right? Mm-hmm. As long as it has been like that, I think there was less of an issue with that. But we are also seeing that already now there are beginning to be some spillovers through the intraday trading in the balancing market as well. That is cross-border, especially between wind plants between Germany and Denmark. We see that. So there is something that we need to solve. It's still an unresolved issue, and I think also if we are rolling that fully out into larger markets, I think we will see some more interactions between the countries, and that's something we surely need to keep an eye on. Yeah. Mm-hmm.
And I think
Anna has some more.
I think the third question here was, do we have time? Yes, we have. Annie, do you wanna say something? Yes, sorry.
No, I just wanted to add on the cross-country CFD. I think there's also it's also very relevant whether you do kind of a cross-European auction or something like that, because then you have the different reference prices, and then you have to think how you deal with this. I think this is a very important issue, because then you can think like you kind of incentivize, or you try to provide an advantage for countries with high electricity prices. So you kind of foster renewable energy power plants where you have high market value. So it's more, the electricity is worthier or so. So if you kind of consider a cross-country auction, then it's really becoming important and very complex. Just to add this on this point.
Yeah, maybe just to add one more, we have seen a cross-country auction for solar PV between Germany and Denmark. We have followed it very closely, Anna and me, and there was discussed to use CfDs, but it was just impossible to get the two schemes to work together. To have a plant in Denmark generating power, to have a contract with the German government on a reference price that the German government has zero control over, or can do nothing. So that was just impossible. So we ended up doing fixed premiums, right? Because there is no reference price. And I think that's some of the things that you know, need to be considered in case you really wanted to open that up to a cross-border mechanism. But I don't think that we are there right now in the discussions, really.
Yeah. Just to add a couple of comments, I would say regarding this cross-border, I think that it is quite useful, the experience in capacity remuneration mechanism. I think that everything that has gone, everything that Acer has published about that, it is quite useful, because the situation is very similar. It is very difficult not to affect the equilibrium, so some level of coordination is necessary, and this, of course, implies allowing cross-border participation somehow. And I would say about the other two questions about distortions, I would say that whether or not this can interfere with long-term markets depends on the type of contract, the type of CfD that we are designing. Well, first of all, we have said that we don't have the market right now, so we are going to distort a market that doesn't exist. So we don't have markets for contracts that are beyond 3-4 years. There are some PPAs, very particular cases that needs to be analyzed. It is not really something that the market is demanding in large quantities. So it is a market that does not exist. But also, depending on how we design this contract for differences, it is not the same, for example, an option that a forward. So there are contracts that still leave some room to the markets to develop if we are lucky in the future, because there is a lot of people that believe that in the next decade, these markets are not going to develop either. And regarding the problem with intraday markets, that was also another question, the distortion with intraday markets. I think that this has a lot to do with the contracts that are as produced. This introduced many distortions that have led to inefficiencies in subsequent markets. There are many examples about that. But there is another thing, that even if we define a contract that is not as produced, as Lina mentioned before, that is based on a fixed quantity, when you define the reference market, the market in which that is going to be settled, you are going to concentrate the liquidity on that market. It's inevitable, because it's your natural hedge. So if you say that it's going to be settled in the day ahead, that plant is going to try to declare the program in the day ahead, and the liquidity is going to be affected. Again, it's very useful, for example, the experience in capacity remuneration mechanisms, the reliability options, the discussions that there have been in Italy, in Ireland, in Belgium, considering the possibility of defining contracts that have multiple markets for the settlement. The discussion was there, and it is this, trying precisely not to interfere, to distort this sequence of markets. Okay, that's all.
Excellent, Pablo. I had honestly a personal question about state aid, and we don't have definitely time to go into this. Perhaps Lena and if you would like to mention, because definitely the most popular question was about forward markets, liquidity on the forward markets. If you wanted to say a few words in the end, And then afterwards, I would pass to Leonardo to conclude it.
Okay, a general concluding remark, not on the forward market side. Yeah, I think the discussions are very relevant and very important, and there are a lot of open questions, unanswered questions. I think you have heard from our side, so I think we can use all the help there is, to get these questions answered, especially also because of the speed that the European Commission has laid out for the market reforms. I think that's really ambitious, and we should really avoid to point towards an instrument that that has so many different nuances and facets that we so I think that really needs to be explored. And then maybe it's more important to point towards certain characteristics that need to be designed, instead of pointing towards a certain instrument that needs to be put in place. So I think maybe that's the one takeaway that I find relevant for now. Yeah.
Very nice. Anna, you also, we're out of time, but if you also still want to have
great, but there's no one
remark?
there's no one fits all solution in this topic. It's too complicated, so it needs to be considered. It's just the same as Lena said, a bit shorter. So
thank you. And I think Pablo also made a nice general comment, right? That a lot of the issues we face now regarding this instrument, the parallel with CRMs, I think, is quite interesting as well. Yeah, we also try to come to principles, right? On the kind of principles we want to see in these mechanisms if they are to be deployed. Really, really interesting. And then the state aid aspect, I think, Lucila, at some point you can pick up. You can invite some lawyers in your network to discuss this aspect in more detail, because probably we can spend the whole hour discussing that dimension, right?
Yes. Yes, and as far as the new instrument, definitely we don't have case. So basically, we would have to discuss what are the potentials of state aid risks, disputes, risks coming from this mechanism.
Great. Okay, then the conclusion is just to thank you once again. It was really, really, really interesting, and thank you for sharing your expertise with us. And I hope that you will be listened to in this whole conversation, because indeed everything is so going so fast that it's really necessary, to bring in experts like you in this conversation. So